In 2008, the collapse of the U.S. housing market triggered the downfall of countless banks and financial institutions across the world. This crisis sent shockwaves through the global economy. Trillions of dollars vanished overnight. Businesses fell apart, families lost their homes, and in countries like Spain, the impact was devastating. Nearly 37% of young people were left without jobs. So what exactly caused the economic meltdown of 2008? And from it, we'll draw lessons about greed, smart investing, and staying calm in a volatile market. This video was researched and compiled from multiple sources, combined with my own opinions and personal perspective. So if there's anything inaccurate or that needs correction, please feel free to leave a comment below. The story begins back in the 1990s, an era that marked the explosion of the information technology revolution and the birth of Windows 95. With extraordinary and promising advances in science and technology, a wave of speculation and enthusiasm for tech investment swept through Wall Street. And it might have continued to grow if it weren't for a series of disastrous events, starting with the September 11th attacks, followed by a chain of collapses that stretched from 1999 to 2001. What exactly happened during that time, and how did those events affect the US economy? I'll save that story for another video. For now, let's focus on the main issue here. With negative market signals piling up, investors and banks became more cautious. And naturally, when the market turns unstable, people tend to buy government bonds, a form of politically backed, ultra-safe investment, which at that time carried a yield of about 6.5% as set by the Federal Reserve. However, having large reserves of money locked up in treasury bonds doesn't necessarily make a country wealthy. Money needs to flow through the economy, into the hands of investors, especially dynamic private enterprises, to keep growth strong and sustainable. So between 2001 and 2003, the Fed continuously cut interest rates, eventually dropping them to just 1% by mid-2003, in an effort to stimulate business activity and consumer spending. We've talked about this before. When interest rates go down, people borrow more. More borrowing means more spending and investment, and that drives the economy forward. But lower rates also made treasury bonds far less attractive. Before, everyone bought bonds for safety. But now, why settle for low returns when you could earn more elsewhere? As a result, Americans suddenly found it easier to access cheap credit, opening the door to a higher standard of living and giving the US economy a burst of energy, especially between 2004 and 2008. At this point, investors no longer chased after those bubble tech companies. They turned their focus toward assets that seemed solid, reliable, and impossible to lose value. Real estate. There's a Vietnamese saying, "And see you lac ngiep," roughly meaning, once you have a home, you can build a stable life. I'm not sure Americans have the same saying, but buying a home was definitely a top priority back then. With extremely low interest rates, people felt confident walking into banks to borrow money and buy houses through mortgage loans. A mortgage loan means the borrower must leave behind some form of collateral to guarantee the loan. If the borrower can't repay, the bank has the right to seize that collateral. Naturally, most Americans used the very house they were buying as their collateral, so they got to own a home, didn't seem to lose anything, and believed they were securing their future. Who wouldn't do that, right? So how exactly did this home loan process work? Let's say you want to buy a house, but you don't have enough money right now. You go to the bank and ask for a loan. The bank will lend you money if they believe you have a stable income and, more importantly, some kind of asset to use as collateral. No collateral? No problem. Just use the house you're buying. The amount you borrow is called the principal, and the extra amount you pay each month is the interest. Your responsibility is to make both principal and interest payments on time. Can't pay your debt? Then the bank takes your house. A pretty normal credit activity. At least, that's how it looked on the surface. Now back to the United States. Because interest rates were so low, the number of people borrowing money from banks to buy houses skyrocketed. For about 10 happy years, America was thriving. The poor could finally buy homes, the rich bought even bigger ones. Real estate brokers earned easy commissions, and banks gained piles of debt contracts, which they magically turned into financial products to attract investment capital. Investors, seeing these mortgage contracts as safe as government bonds, used heavy leverage to speculate. At that moment, banks came up with a new idea: to combine all these home loans together and create investment packages called MBS, mortgage-backed securities. To explain it simply, let's say Bank A has 50 mortgage loans with a total value of 100 billion jong, each with different interest rates and terms. Those 50 borrowers pay interest to the bank every month. But after lending out all its money, Bank A no longer has funds to keep lending. So what do? They decide to create an MBS, a mortgage-backed security, divide it into smaller portions, each worth, say, $10,000, and sell them to investors. Like slicing a big cake into small pieces. Once sold, the bank receives fresh cash from investors along with a profit margin, giving it capital to keep making new home loans. Investors who buy those small portions of MBS receive regular payments from the bank, or more accurately, from the 50 homeowners paying their mortgages. So basically, it's a kind of money circulation system. You've got idle cash, you buy MBS. Each month you get interest payments. It's reasonably priced, seemingly low risk, and backed by banks. What could go wrong? When first introduced, MBS products instantly caught attention and quickly became a hot new investment trend. Demand surged, prices rose, and seeing that, banks began creating even more MBS packages to sell. But to make more MBS, you need more people borrowing money. And to qualify for a loan, borrowers traditionally had to meet certain conditions: stable income, clean credit history, and of course the ability to repay. But not everyone could meet those requirements, yet banks were desperate for more borrowers to generate more MBS packages. So they started offering subprime loans, loans made to people with poor credit, unstable income, or past financial troubles. In simple terms, banks began lending to people who were far more likely to default. They were deliberately taking on extra risks just to keep the machine running. The credit market exploded. Even people with no ability to repay could easily borrow money to buy houses. Homebuyers flooded the market. Banks created endless streams of MBS packages, and huge amounts of money poured into the financial system. With so many people profiting from the MBS boom, banks took it a step further, creating even more complex investment products, most notably CDOs, collateralized debt obligations. What were CDOs and what did they mean? Let's take an example from the movie The Big Short. It makes it easy to understand. Imagine I'm a famous chef running a restaurant. On Sunday, I realize that the fish from Friday hasn't been used yet. What should I do? Throw it away? That'd be a waste. So as a creative chef, I toss all that leftover fish into a big seafood stew, add some spices and toppings, and voila, a brand new dish is born. Customers eat it happily, completely unaware that it's made from 3-day-old fish. Whether they get stomach aches later, not my concern. That's basically how CDOs worked. The unsold MBS products, the leftover fish, were bundled together by banks, then divided into layers of different risk levels and sold to investors. The safe tranches offered low returns, while the risky ones promised higher interest rates. The problem? MBS were already risky to begin with, since they were based on loans that might never be repaid. So CDOs just multiplied that risk, spreading it across the entire financial system. Credit rating agencies then stepped in, assigning ratings from AAA, lowest risk, down to CCC, highest risk, most likely to default. Investors relied on those ratings to judge safety, and banks used them to justify even more lending. This cycle fueled the creation of more subprime loans, allowing even unqualified borrowers to buy houses, which inflated the housing market to absurd levels. You might ask, wait, wasn't anyone regulating this? Didn't someone warn investors that these were bad loans? Well, there were regulators, but they partnered with the bank, Many MBS and CDO products were rated AAA, the same as US government bonds, even though they were filled with toxic, high-risk loans. Credit rating agencies were paid by the very banks whose products they rated. So unsurprisingly, they gave inflated scores, because everyone believed housing prices would never go down.